Ladies and gentlemen, good day and welcome to the Q1FY23 earnings conference call of Lumax Industries Limited. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Anmol Jain, Joint Managing Director of Lumax Industries Limited. Thank you, and over to you, sir.
Thank you very much. A very good afternoon, everyone. I hope everyone is in good health. Along with me on this call today, I have Mr. Shrutikant Rustagi, the CFO of the company, Ms. Priyanka Sharma, Head Corporate Communications, Mr. Ankit Thakral from Corporate Finance, and SGA, our Investor Relations Advisor. The results and investor presentations are uploaded on the stock exchange and company's website. I do hope everybody has had an opportunity to go through the same. We have been witnessing consistent performance across all the sectors in the auto industry in the last 3 quarters and are now envisaging the industry moving towards pre-pandemic levels. The monthly data released by auto OEMs and FADA are very encouraging, and with the optimism and stability in the economy post-recovery from the long-drawn pandemic effect, healthy monsoon season for generation of demand from the rural economy, and with the festive season around the quarter, we firmly believe the industry should perform well in the coming quarters of the current fiscal. We are not only witnessing growth in the industry, but are also witnessing a steady shift in the consumer buying behavior. The shift is towards more technologically advanced and premium products by OEMs in line with the future of mobility as per global standards. We have been witnessing stronger demand of premium variants in existing models and across the new launches. Favorable government policies and incentives in the form of PLI schemes to boost the local manufacturing and reduce dependency on imports in the long run and provide thrust to the overall auto industry growth. With new launches in the pipeline by various OEMs, we are all geared up to capitalize on the same with our technologically advanced lighting solutions and long-standing relationships with our customers. This gives us a great opportunity to further capture market share in the lighting domain. I'm happy to share with you that your company has a healthy confirmed order book of around 1,000 crores. 90% of it is in new business, and out of which 30% of the orders are from EV models. We at Lumax Industries are the market leaders and preferred partners for OEMs in India for automotive lighting solutions in the two-wheeler, passenger vehicle, farm equipment, and commercial vehicle segment. Our technical and financial collaboration with Stanley Electric Japan of over 4 decades makes us efficient in localizing the global technologies and trends. We're expecting new technologies such as adaptive forward lighting, adaptive driving wheel, projector systems to play a very important role in the growing SUV segment, and we are working with our customers to develop these products locally. At Lumax, we are also upgrading our technological capabilities with more focus on R&D and enhance our products for a higher share of market across OEMs. We continue to work on design and development to innovate and provide local solutions best suited for the evolving auto industry in India. Let me now speak about the new product launches made during the quarter. During Q1FY23, the following new models have been launched with Lumax lighting solutions. For Mahindra & Mahindra, the Scorpio N platform, all the lightings, that is the headlamp, tail lamp, fog lamp, reverse lamp, and the high mount stop lamp belong to Lumax Industries. For Maruti's XL6 model, the tail lamp, the rear combination lamp, and the rear panel garnish. for MG Motors Aster model, headlamp and tail lamp. For commercial vehicles, we are also supplying the headlamp and tail lamp to Mahindra & Mahindra for the pickup model, headlamp to Eicher Motors for the family look tractor, and the side indicator and front reflector to Tata Motors for the infra model. The company has also been awarded with the Best Overall Performance Award for FY21-22 at the Maruti Suzuki Vendor Conference held in May 2022. And the Bengaluru plant of the company won the Gold Award under the category of Productivity Improvement in CII National Competition on Low-Cost Automation held in July 2022. Now I would like to hand over the line to Mr. Shruti Kant, the CFO of the company, to update you on the financial performance of the company.
Good afternoon, everyone. Let me brief you on the operational and financial performance for the Q1 FY23. The share of LED lighting for the quarter stands at 33% and conventional lighting at 67%. With respect to product mix for Q1 FY23, as a percentage of total revenue, 64% revenue is from front lighting, 24% from rear lighting, and 12% from others. With respect to segment mix for Q1, as a percentage of revenue is 66% from passenger vehicle, 28% from two-wheeler, and 6% from commercial vehicle. With respect to financial performance, the revenue from operations stood at 512 crore for Q1 FY23 as against 314 crore in Q1 FY22, up by 63%. Revenue for Q4 FY22 stood at rupees 549 crore, down by 7%. The company reported consolidated EBITDA of rupees 48 crore with a margin of 9.4% in Q1 FY23 as against 8.6 crore in Q1 FY22, a growth of more than 462%. PBT before exceptional expenses and share of associates is rupees 23.5 crore in Q1 FY23 versus a loss of 12.9 crore in Q1 last year. CapEx for the current quarter stood at rupees 13 crore. This is all from my side. We will now open the call for questions.
Thank you very much. We will now begin with the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Ashin from Equirus. Please go ahead.
Yeah, hi. Thank you for the opportunity. So, sir, my first question was regarding margins. So, we've seen a sequential decline in margins. So, could you please elaborate on that? We've seen huge increase in other expenses and employee expense.
Could you please repeat the question? I wasn't clear. You said something about...
So my first question is on margin. So we have seen a decline in margin sequentially. So could you please explain that?
So if you look at the margins from sequentially, I think you are looking at it including the tooling. So if you tooling, as I mentioned earlier, is a outcome of multiple factors. So if you take out the tooling income by itself, because there was a strong tooling income in Q4, and tooling is dependent on the launches schedule as per the OEM's launch plan. So if you take that out purely from a manufacturing point of view, I think we were able to sustain the sequential margins. There may be a few bits gap, and that is mainly because of certain raw material price escalations, which we are expecting in the subsequent quarters to be recovered from the OEMs. But barring that, there were no anomalies in the current quarter which would put pressure on the margins.
Okay. And so with the price pass-through coming in, do we see margins going to double digit from over here?
Well, absolutely. That has been the endeavor, that the EBITDA margins should for the company get to double digits, and I think that would be let's say guidance for the current whole year, that we should get to a double-digit margin on an EBITDA. I think if I look at historically, I think in 2019-20 is when the company had reported a double-digit EBITDA on the back of, let's say, the peak year, which was 18-19 revenues. So I think, as I mentioned in my opening comments, the current year we do envisage the industry bouncing back to pre-pandemic level volumes, and it automatically would mean that we should be able to get into the double-digit margin space.
And so this 300 crores order which we have got from an EV, so is it for two-wheeler or four-wheeler? And could you please elaborate on that?
So the 300 crore EV is across various models. It is not for one particular model. It's a combination of four-wheelers and two-wheelers. However, I would say the majority of that 300 crores would be on four-wheelers, because the contribution per vehicle on a four-wheeler is much, much larger than that of a two-wheeler.
Okay. And this 100,000 crores order book, when would it go into production and when would it peak out?
So I would say about 20 to 25% of this would probably get in the current fiscal as well. I would say 70 to 75% of this peak revenue would probably come in the next financial year in FY24, and in FY25 we would have the 100% revenue in our books.
Okay. Thanks a lot. That was all from my side. Thank you.
Thank you.
Thank you. Participants, to ask a question, you may press star and 1. The next question is from the line of Abhishek Jain from Dolat Capital. Please go ahead.
Thanks for the opportunity. Sir, krypton gas prices is still higher due to the disruption of supply from the Ukraine and Russia. So are you confident of improving gross margin in the coming quarter?
Yes, I think we are very confident. I think if you look at the gross margins, they have been, I would say, steady even in the Q1 compared to FY22 full year. I think the raw material consumption has been stable. As I said before, there may be a lag of 1 quarter or 2 quarters because of the hyperinflation. But I think as the raw material prices also seem to have softened now, we do not anticipate any negative impact on the gross margins. So we would like to definitely believe that the gross margin would continue as they have been in the past.
So what are the key raw materials where you are able to pass the cost to the end clients, and where is the obstacle?
Can you repeat that question? Your voice was a little echoed.
What are the key raw materials where you are able to pass on the prices to the end consumer, and where is the obstacle?
So I think most of the raw materials, I would say in plastics, our biggest consumption would be on polycarbonate as well as on PMMA. Polypropylene is also a very big material for us, ABS being the other. So I think across all plastic raw materials, we are able to recover the cost escalations from our OEMs. Also, there are significant increases in copper, which is a very integral part of the wiring assembly. So these are things which we are able to get back from our OEMs, and as I mentioned, it's just a 1 or 2 quarter lag between getting the incremental increase.
But if I see the numbers of the other peers, they are not able to pass on the prices of this krypton gas prices that is much higher right now. So what is the impact there?
The impact of what? The
gas prices.
Is significant, but as I said, we are able to recover most of this impact from our OEMs.
Okay. And as you have gone for the backward integration through PCB in the bowel, so what benefit you are looking from that plant? It is 100 bits benefit in the gross margin or 150 basis gross margin?
Yeah, so between that, I think the whole idea of backward integration was more strategic to have a full control as electronics become a very key part of the lighting systems going forward. By this backward integration, obviously we also mentioned that there would be an expansion of margins between, let's say, 100 to 150 bits. And we did see that margin expansion. I think there has been lately also some bit of foreign exchange fluctuations, because of the currency devaluation. That has also taken a bit of hit on the electronics because there is still the board which is imported. So because of that, some of that margin may have gotten nullified, but as we go forward with our capacities getting expanded, with our revenue pie growing, we do expect that we will be able to get back on that savings on the margins aspect.
And sir, your import content in terms of the LED lamp, it is around 50 to 60% on the headlamps and around 30% on the tail lamps. So what is the impact you are facing because of the fluctuation of the JPY and USD? Are you getting some benefit of the appreciation of rupees against the JPY?
So most of it is in USD, not JPY. And as I said, we do try to get the recovery from the OEM for the most part for this foreign exchange. You're right, the LED content is still on the passenger car headlamp is still high at about 60 odd percent. But again, going forward, we do have plans to localize in phases to try and minimize the foreign exchange risk.
So how much loss you incurred in this quarter from the foreign exchange fluctuations, and where did you saw it?
So the loss in absolute amount was about 2 crore rupees.
Okay.
But this is again more of a notional loss because it is just an accounting entry. It is not that there is a physical loss. It is more of a bookkeeping.
Yeah, this is mostly unrealized loss as per the accounting standard.
So it has shown in the other income side?
No, it is net of the admin expenses, other expenses.
Other expenses. So most, so if we exclude this foreign exchange gains, so your margin would be the slightly better than the current margin. I mean 8.4%. It would be around 9%.
That's correct, and this is a foreign exchange loss. I just wish to correct that, not a gain.
Yeah. Okay. And sir, my last question is related with the shift in the volumes in the passenger vehicle, that is continue on the SUV side, and Maruti is also coming with the mid SUV segment, So how do you benefit in terms of the content per vehicle because of this?
Well, as I mentioned, the SUV segment is constantly growing at a rapid pace. I think almost 50% of the market today has moved to a SUV segment. Not just Maruti Suzuki, but across all OEMs, they have very aggressive plans for new launches in this segment. How do we gain is because SUV segment usually we try and we are seeing that they are getting technologically much more advanced features, be it in the internal or the exterior, and lighting solutions becoming one of the key aspects of it. I think we see a lot of the new technologies being adapted in the SUV segment first rather than the passenger cars. So as I mentioned, with the help of our collaborator Stanley Electric, we are in the process of discussions with OEMs to adapt these new technologies for the forthcoming models. And that's how with the new technologies, the contribution per vehicle also goes up.
So how much difference in the content per vehicle in passenger car versus SUVs?
It's very difficult to predict and give you an answer like that. It depends really on model to model. There are passenger cars also which have the same technologies. I never said that passenger cars do not or are in any way technologically inferior. I was just giving you a reference that usually in SUVs we see a faster and a higher technological adoption than passenger cars because of maybe different price points as well.
Okay, sir. Thank you, sir. That's all from my side.
Thank you.
Thank you. Participants, to ask a question, you may press star and 1. The next question is from the line of Parag Someshwar from AG Securities. Please go ahead.
Yeah, I have two questions. First is your largest customer Maruti has launched two new models, new Brezza and Grand Vitara. So will you be supplying LED headlamps and tail lamps to these two models because they will have very high value products?
So we are not on the head and tail of both these models. We are on certain lamps on the Brezza. And the reason for that is very simple. Maruti does not, and it is more of a strategic decision, that there are certain models which are given to us, and I believe, and I can't disclose that, but there are a lot of forthcoming models as well, which we have been able to secure. I mentioned that there is a 1,000 crore order book which the company enjoys, and definitely there are some forthcoming models of Maruti Suzuki in that order book as well.
Okay. I think some code name YSR or something, right?
Well, there are always code names, but I would not be in a position to divulge the code name for our future order book.
No problem. Now, second question is on your margins, EBITDA margins I am talking. In the last 6 years, except 1 year, you've been operating at an EBITDA margin of about 8%. Whereas if I see your nearest competitor, Merrily Motherson, they have been consistently doing EBITDA margin of 18 to 20%. So why are you operating at less than half their margin? What are the reasons for that?
So there are multiple reasons. I think you cannot just look at the peer because you have to also understand with the kind of scale and with the kind of technology and R&D, there is a much different cost structure. And I would not like to name any particular competition, but the one you mentioned, I would say that their presence is more as a manufacturing organization. There is not much of R&D work which happens locally. R&D may not be adding to the margins, but it surely continues to help you make your market dominance present and increase the market share with localized solutions. So I would just say that it might not be an apple-to-apple comparison. I think we also have multiple facilities which operating at very high margins. But overall, because of the scale and size, there are certain inherent cost structures. So I would not comment on the 18% EBITDA margins, but our endeavor has always been, and I think I've consistently maintained that we anticipate our margins to, in the near to mid-term, get to a teen level, more like a 13% EBITDA, is something which we foresee as achievable. And as I mentioned in the current year, the guidance I would like to give is that we should definitely be back in the double-digit margin space.
But this 8% and 18%, don't you think that's too large a difference for whatever reason you might give us?
Well, the difference is very much there, but you will also have to understand that there is a certain, difference in terms of the revenue as well. So if you look at the revenue pie also,
I have seen that Maruti is also their largest customer. Yours is also Maruti. And they are 2/3 of your size. They are not.
They're the largest customer for multiple people. But the point I'm trying to make is that with the scale and when you have multiple geographies, and Maruti may be their biggest customer, Maruti may be my biggest customer, but please also understand that Maruti is about 1/3 of my customer base. For them, Maruti must be a much more significant part of the pie because they may not have those many customers. So again, as I said, there is definitely a constant endeavor to expand our margins, but to take a yardstick of 18% may not be necessarily the right benchmark.
Because even the employee cost, they have about 6.5%. Your employee cost is 14%. So on most of your parameters, your cost structure seems to be very. I don't know what is the reason for that.
Sir, I completely agree and understand, but please also understand that please also look at the aging of the organization. When Lumax Industries came into existence and when the competition came into existence, please understand with each passing year, there are certain cost structures which get attached to the organization. And again, we don't look at just one lighting company, but if you were to take and benchmark amongst the, let's say, top 25 tier 1 auto component companies, I think we are not very off in terms of the average EBITDA margin commanded by the tier 1 industry.
I think most of the good auto companies are already doing double-digit margins. Even if I take a lighting company which is primarily into two-wheeler, PM, and generally cars, I suppose, would have a higher margin than a two-wheeler. They also do 13% margin consistently, which is also higher than yours.
So as I mentioned earlier, double-digit margin is something we are definitely giving as a guidance that this year we will be bouncing back into the double-digit space. As I also mentioned, a 13% margin is something which definitely is achievable in the foreseeable future, and we are working, our efforts are towards getting to that space.
Best of luck, and that's all from my side.
Thank you very much.
Thank you. Participants, to ask a question, you may press star and 1. The next question is from the line of Mahek Talati from Yellow Jersey Investment Advisors. Please go ahead.
Hi, congratulations for good set of numbers for the quarter. I just started to read your company and I had few questions. First was, what is your kit value for the LED and conventional lighting?
So it depends really on the segment. In the two-wheeler and in the four-wheeler, it would hugely differ, and it would also be very different for a headlamp and a tail lamp. But just to give you some sense, on a conventional two-wheeler headlamp to a LED headlamp, the pricing goes up by almost 2.5 to 3 times. On a tail lamp, it would probably go up by 2 times. And on the four-wheeler or passenger car, it can go up on a headlamp as high as maybe 4 to 6x, and on a tail lamp, probably about 3 to 4x. This is just the kind, it really it depends on the kind of technology, what function is in LED. But just to give you an overall range in terms of how the pricing behaves, I would say that this is the difference in the pricing.
Okay. And secondly, I wanted to ask, what is your capacity as per product wise? Like how many headlamps can you make per annum and how many tail lamps?
I do not have that figure right away. It really differs, and it's very, certain plants cater to only two-wheelers. It's simpler to calculate there, but there are certain processes which cater to different type of lamps, four-wheeler, two-wheelers, head, tail, small lamps. So it would vary plant to plant. I don't think it's probably fair to give you a number in terms of this is our total vehicle capacity. But if I were to look at it differently, I think if the market of pass cars is give or take, let's say about 2.5 million, and we do have a 60% market share. So I would safely say that we would have installed capacities of approximately 1.5 million, give or take, in terms of the four-wheeler, and two-wheelers would be a lot more because of the sheer volumes being multifold. We do almost 16-18 million two-wheelers a year in India. So in terms of numbers, it would be much, much higher, but that's what I can say. But I think more importantly, what we measure is our capacity utilization. which is something which is more important.
And third, I wanted to know what are your components that are imported and how?
So for the most part, just the LED and the electronic of certain particular model, that is what is imported. The raw material for the large part is localized, but for some special grade raw materials, we may have to import them at the behest of the customer. So apart from raw material and electronic or LED parts, there isn't anything which we import or are dependent on imports.
How much is LED imported? Percentage can you give?
So the imported content on a LED again would be very different in two-wheelers and four-wheelers. In two-wheelers, I would say it would be about 25 to 30% imported content, and on a four-wheeler, I would say it would be give or take 50%. It really would differ again on a headlamp and a tail lamp, but just to give you an overall perspective, the import content would be higher in a passenger car.
Okay, that's all. Thank you.
Thank you.
Thank you. Reminder to the participants, anyone who wishes to ask a question may press star and 1. The next question is from the line of Jia Verma from MR Securities. Please go ahead.
Hi, sir. Thank you for the opportunity. I have 3 questions. So firstly, with all the new launches planned, as we heard, this year and the next year by OEMs, do we see any increase in demand or addition of wallet share among OEMs? What is the product approval process and cycle for new launches? And how do we ensure that the larger proportion of the business is acquired from the new products which have been launched?
So just to give you a flavor, I think I mentioned that the order book of the company is a healthy, let's say give or take 1,000 crores. I would say a significant chunk of it, almost close to maybe 60 to 70% of that order book is in the passenger car segment. In line with our overall pie, I mean, if you look at the last quarter, 66% of my revenue was in passenger cars. So the order book is in the similar line. In terms of, you mentioned particular OEMs, I think we have maintained our wallet share with pretty much all OEMs. We do not anticipate any decline in our wallet share in any particular OEM. But we have some strong order book from certain OEMs across, be it Tata's, be it Mahindra, be it even Maruti Suzuki. So I don't see any significant reduction in any wallet share, but I would say that we might be able to increase our footprint in someone specifically like a Mahindra in the passenger cars, because there has been recent launches, and we are very proud that most of the recent launches, for example, the Scorpio, the complete lighting solutions is by Lumax.
Right. And since the auto industry is moving towards premium products and the consumer preferences have been changing, do we see a shift in our product portfolio from conventional lighting to LED lighting? Also, what are the realization differences between conventional and LED lighting?
Absolutely. I think we have seen a shift towards more LED adoption. To give you a flavor, in the last 3 to 4 years, there has been a much more rapid change in the two-wheelers. I mean, 3-4 years ago, almost it was a 80-20. 80-20 was non-LED and only 20% of the two-wheelers had LED lighting. Today, that number is almost close to 50-50. It might be a 55-45, but almost 50-50. In the passenger cars, I think because of the price sensitivity, the adoption was slower. I think it was a more 75-25 earlier, 75 being conventional and 25 being LED. I think today it's almost 1/3, which is LED. But going forward, I think we see a much more rapid progression because, as I mentioned, the consumer behavior has changed. The A segment, which was the entry level, that segment by itself has really declined. And SUV segment, which is, let's say, a little more premium, where all these technological advancements happen, it's become 50% of the market. So going by that thumb rule, I think the LED adoption would be far more in the coming times, and we see that in our order book and in terms of the new RFQs we have. So definitely faster adoption is expected in the SUV segment and in the other segments going forward. You mentioned about the pricing. I think I mentioned earlier that the pricing almost differs in the pass cars anywhere between 3x to 4x on a tail lamp and maybe about a 5x to even as high as 7x depending on the kind of technologies on a headlamp. And in the two-wheeler it would also be about 2x to 3x on a headlamp to a tail lamp. So definitely there is a very big upside on the conversion towards LED.
Right, fair. And if you could also help me with the margin difference between LED and conventional lighting.
So I would say that in terms of the margins, definitely LEDs would have a almost higher margin than the conventional, but it would not be at a gross margin level, because the gross margin, I would say, because of the imports dependability, the gross margin is lower in a LED. But then because the other cost structures get they're not as significantly higher because the revenue per vehicle is much higher. So the other cost structures at the value addition and the operational level, they actually are much more negligible than that of a conventional on a percentage basis. I'm saying not an absolute amount, and hence the EBITDA margins do get better on a LED technology rather than a conventional one.
Okay. Thank you. That was helpful. Thank you and all the best.
Thank you.
Thank you. Participants, to ask a question, you may press star and 1. The next question is from the line of Ashutosh Tiwari from Equirus Securities. Please go ahead.
Yeah, hi. Firstly, on this 30% result of order book is EV side, which are the key OEMs over there?
I'm sorry, you're not audible, Mr. Ashutosh. I'm not sure if you're on speaker, but your voice is a bit...
Sorry, I was in your order book of 1,000 crores, you mentioned 30% is from EVs. So which are the key OEMs over there?
So there are multiple OEMs. I mean, there is Tata Motors also, there are two-wheeler makers also, there is... other OEMs also. There are multiple OEMs. Again, as I said, I may not be able to divulge details because a lot of them may have not unveiled their electric vehicle plans, but it is a mixture of four-wheeler, pass car OEMs as well as two-wheeler OEMs. And this is what we have already secured. We are also in the process of very advanced early stage discussions, early supplier involvement with certain OEMs for their future EV models. So clearly, we are in dialogue and discussions across the OEM spectrum for the EV requirement. And I would say it's more on passenger cars. I mentioned that earlier. It's more on the passenger car models, but there are some two-wheelers as well. And our focus is very clear that on a passenger EV vehicle, the contribution of the revenue per vehicle is far more significant. It's probably as high as selling 5-6 two-wheelers. So our resources and our capacities we want to utilize towards the EV for passenger cars more. But having said that, we are also engaged with the two-wheeler OEMs.
Okay, and on this Scorpio, were we also supplying the earlier older model all these lamps?
Yes, we were on the older model as well, and we continue to be on the new model as well.
But there is a lot of LED lamp on this new model, so just a broad idea how the content would have changed in new Scorpio versus older Scorpio, on an average basis, I'm saying.
So there is a significant change in yes, you're right, there is a lot of LED technology usage in the new Scorpio. But again, I would not be able to give you an accurate number, but I think we can get back to you on that. But I think it should be definitely upwards of 3x compared to the old Scorpio to the new Scorpio, 3 to 4x.
But that would be only for the, like, say, top variants, or on an average, you're saying that including the entry variant, basically the increase will be that much?
So there are lamps which are common, which are across the variants. There are certain lamps which are different for the top variant versus the base variant. There will be still a plus X delta even for the lower variant. The delta may be slightly lower than that of a high variant. But having said that, I also want to say that majority of the bookings and the orders which we are seeing in terms of the production pull is actually a significant part of it is for the higher variant. The lower variant, there is probably obviously there is a pull, but it's not the major demand puller.
Okay, got it. So I mean, because the bookings are higher for the upper variant, that's why you're saying that there is a lot of increase in the content.
In my opening that we see a significant shift in the consumer behavior towards getting the high-end variants and the technologically advanced models.
Okay. And generally in SUVs of, let's say, your 10 to 20 lakh category, what would the content of lighting basically of LED and versus if it is completely halogen?
It really again depends on the kind of technology, and the LED usage in a tail lamp would have a very different, even though it qualifies as a LED lamp in terms of numbers, but in terms of revenue it would have a very different impact vis-a-vis a LED headlamp. But I would say that a 5x is a good benchmark to say that if a conventional SUV or a conventional car is at an X price factor of the lighting per vehicle, easily it would go up by 4 to 5x on a platform which has much more penetration on LED across the lamps.
And lastly, obviously, you're clearly seeing that in most of the new model launches, lighting is one of the differentiating features of the model. So, in terms of order book, you're clearly seeing a shift that probably will go towards 60-70% in the next 3 years, 4 years time frames in the LED mix in the lighting revenue.
In terms of LED, you're saying?
Yeah, LED, yeah.
Yeah, I think so. I mean, as I said, two-wheeler is already at a 50-50 level, give or take. Passenger car is, as I mentioned, about 1/3 is LED today, but that was also significantly different because there was a very large A segment, the under 5 lakh segment, which was really thriving and getting the volumes. But since that segment has really become much lower as an industry, and I believe that the SUV segment and the other premium variants are selling more, so I would definitely think that this 1/3 pie should, at least in the next few years, depending on the order book also, we are seeing the similar traction. I would say go to a 50-50 like the two-wheelers.
But when you say this number 50% or 33%, that's in terms of revenue. It's not in terms of volumes. Volumes are still much lower.
That's correct. We are talking about revenues.
Yeah, because actually when the transition happened, you will probably see shift in terms of volume, but still the larger shift has to happen to LED. Okay.
That's correct. And please understand that even on a SUV or even on a premium variant, it's not necessary that all the lamps are LED. It could be that one particular lamp is LED and the remaining lamps aren't LED. So when I look at the value per vehicle, obviously only the LED is taken into consideration, but then there are also other conventional lamps which still go onto the vehicle.
Okay. And like you said, it's probably two-wheelers 50%, but if in terms of value, then probably in terms of volume, still that is 25% only because at least are 2x costlier than halogen. Broadly, I'm saying in that range.
Sure.
Yeah. Okay, thanks a lot.
Thank you.
Thank you. The next question is from the line of Abhishek Jain from Dolat Capital. Please go ahead.
Sir, how much incremental revenue will come from the Sanand plant from this fiscal year, and who would be the clients?
So Sanand plant caters largely to the likes of Maruti Suzuki and MG Motors.
30 to 44.
And the incremental revenue from last year to this year on this plant would be
310 crores.
about close to 100 and 150 crores for the full year.
Okay. And sir, your current capacity utilization is around 80%, and OEMs are guiding around 18 to 20% growth in the passenger vehicle. So, are you looking to increase your capacity?
So overall, you're right. Our capacity utilization would be about 80%. But if I look at certain regions, the capacities may even be stretched to a 90% mark. I think Sanand being one region, even after the brownfield expansion which the company had undertaken, we do expect that maybe the capacity would be as high as 90%. The western region also, because of a very strong comeback with certain OEMs like Mahindra and Mahindra, and also a very strong order book with few customers based in that region, I do anticipate the western region capacities also to be peaked at about 90% sometime during this year.
So, are you looking to capex for the next 2 years? So, just wanted to know the numbers you are planning.
So capex plans this year is about 80 to 90 crores of capex, which are mostly towards just regular capex need, certain brownfield expansions, etc. We are still evaluating our capacities for the next 2 to 3 years in line with our order book, and we have not yet firmed up, but are in the process of deciding whether we need any greenfield expansion in the coming time or not.
So, as Maruti is also coming with a new plant in Haryana, so most probably would also have a requirement of new greenfield plants. So, just wanted to know your planning for that.
So we, as I said, are still evaluating all options. We are looking at our total capacities in the next 2 years and also regional capacities in the next 2 years. We personally do not anticipate much capacity expansion in the north, even though Maruti is coming out with a new plant, but that plant is in a close vicinity to our existing manufacturing plant. And with that whole infrastructure development, we do not anticipate any need to put up a new plant because the plants in north already have sufficient capacities to cater to the future capacities in the north. But as I mentioned, the west part, be it Gujarat, be it Pune, I think that is somewhere where we may need some capacity enhancements, but we are still in the process of acquiring more data, and with due course we'll be able to give you a clearer picture.
And sir, next question is related with your SL Lumax revenue and EBITDA and PAT in the first quarter FY23 and outlook ahead.
So in the current quarter, the turnover was around 522 crore, and the EBITDA margin is approximately 8%.
8%. And the PAT?
The PAT is around 6%, 4.5%.
Okay, sir. And sir, what is your total debt in terms of the short term and the long term?
At present, we are total debt is around 400 crore.
Okay.
Yeah. And the long term is around 74 crore rupees.
So, why there is a requirement of the higher working capital, around 340 crores to 350 crores?
This is because of the requirement of all the OEMs to keep the inventory level. That's why we are keeping these higher working capital.
And most probably it will go down in the coming quarter because of the lower inventory would be required because of this raw materials issues are easing off, supply issues is easing off.
Yeah. Our target is to reduce this area.
Okay, thanks. That's all from my side.
Thank you.
Thank you. Ladies and gentlemen, due to time constraint, we will take that as the last question. I would now like to hand the conference over to the management for closing comments.
So I would like to thank everyone for joining on the call. I would like to say that we remain confident on the growing prospects of India and the automotive sector in particular. I hope we have been able to respond to all your queries adequately. If there is any further information required, request you to get in touch with SGA, our investor relations advisors. Thank you and stay safe.
Thank you. Ladies and gentlemen, on behalf of Lumax Industries Limited, that concludes this conference call. Thank you for joining us, and you may now disconnect your lines.